Let's get some business news now, and joining me to discuss is Chris Weston, the Head of Research at Pepperstone. Good morning to you, Chris. Thanks for joining us. First of all, I want to get your thoughts on these claims that the US Federal Reserve should be kept independent, and it's claimed not to help Trump during his 2020 campaign.
Yeah, look, I think there's a bit of a roar overnight from Bill Dudley. Bill Dudley used to be the New York Fed president, so one of the core members of the Fed president. He stepped down not so long ago. He wrote an op-ed piece in Bloomberg effectively saying that the Federal Reserve should not only not support Donald Trump in his quest for trade, and Donald Trump, of course, is trying to use the Fed and push the Fed to cut rates quite aggressively by over 100 basis points and start asset purchases with the idea that he can continue with his fairly aggressive or hawkish campaign against China and offset that with easier monetary policy. So Bill Dudley has come out and effectively said that you should not support, the Fed should not support Donald Trump. And some people have actually interpreted this as going even as far as saying that the Fed should work against Donald Trump in his quest for 2020 election, and actually not just being independent, but actually being on the side of the Democrats. I think that's caused a stir in markets. It's kind of why bond yields have fallen. People have been buying bonds on that idea that the Fed, if they were influenced by this, could be signalling a policy mistake. But the Fed do need to remain independent. But those comments from Bill Dudley, was a very important member of the Federal Reserve, has caused a bit of a stir overnight in markets.
There's been such a stoush, hasn't there, between, the President and the Fed Reserve over these, proposed rate cuts. There could well be several more coming. Maybe this is all part of Donald Trump's plan. But there is so much talk now of the US heading into recession, and that might be really bad timing as it goes into that election in 2020, which is around about 12 months away. What are your thoughts on this, Chris? Is the US heading for dangerous economic territory?
I mean, we're going to see slower growth. There's no doubt about that in my mind. I mean, we're going to see the second quarter GDP numbers being revised tomorrow, and they come out, and we're expecting that to come around 2% year-on-year growth. But then again, you take out some of the sort of the indicators we look at for the late cycle economic developments, and when these generally roll over, we see them rolling over into a recession. Take the consumer confidence numbers last night. They came out of that index printed 135, near multi-decade highs. So until the consumer starts rolling over and stops spending, which generally happens in that late cycle before you hit the recession, we're not in those dangerous territories. So some of the data, such as trade volumes, manufacturing, some of the more forward-looking indicators have rolled over, and they're in kind of worrying territory that has us really believing that there is an elevated risk of a recession longer term. But we need to see the soft data and the consumer showing fragility, and we're not seeing signs of that. When that does, then yeah, I'd come out and say we're very, very close to recession. We're not seeing those signs just yet. How
do you think things are going in the short term? Because I noticed that the Dow closed about 0.5% lower overnight.
Yeah, look, I think, the US equity markets are stuck in this kind of short-term range. The bulls don't really have the emphasis to push prices significantly higher, but then the bears, which have had so much ammunition, so many bearish and or negative headlines, haven't really been able to exert their pressure either. So the market's kind of stuck in this sort of psychological battle between, the bulls and the bears, and no one's really able to exert their own pressure. And, of course, in that situation, the market's sort of meandering on sideways. But for me, if I look at some of the internal indicators, implied volatility in these markets, it is elevated, and people are continuing to expect big moves. I think if we are to see one direction break, it's probably to the downside, but I'm not expecting a collapse in market. The bond market tells me to be cautious at the moment. Gold prices tell me to be somewhat cautious. The fact that utilities are outperforming growth stocks tells me to be cautious. But yeah, the market doesn't really want to roll over. So I'm still saying quite cautious, but we're not expecting a collapse in these markets anytime soon.
Closer to home and looking at the ASX, what are you watching closely today?
Well, we're looking for a slightly softer open. We've got the market, the ASX 200, down about sort of 10 to 15 points, so it's not a particularly dark open by any means at all. But we're still holding in the ASX this range of around 6,600 to 6,400, and that seems pretty fair at the moment. Again, similar to what we saw in the S&P and the Dow, the market's not really able to exert any kind of pressure up or down, and we're just sort of moving sideways. And I continue to expect that in the short term. Energy, look, oil prices overnight were up 3%, so energy sector should do quite well. Gold stocks should do quite well, but banks will probably take a few points out of the market today.